For more now on the fate of the Trump tax cuts, no matter who wins the election, let's get to our panel. Kyle Pomerleau is a senior fellow at the American Enterprise Institute, and Brendan Duke is senior director for economic policy at the Center for American Progress. Welcome to both of you. Kyle, let me begin with you.
Thank you.
Does anyone credibly believe anymore that major tax cuts in any substantial way, quote, pay for themselves?
Well, I hope not. I think if you're talking about a $4 trillion reduction in revenue, you're going to maybe impact the economy some ways. You're going to encourage some people to work. Maybe investment rises. That might raise a little bit of revenue to offset the cost, but you're still going to lose revenue overall. And I think the data is pretty clear from the Tax Cuts and Jobs Act from between 2018 to about 2019 that the federal government did lose revenue. Now, that's not to say that the TCJA didn't make improvements to the tax system, but I think it's a stretch to say that that it paid for itself.
How much of the part of that, if I'm recalling correctly, was creating a window through which U.S. corporations could bring foreign domiciled profits back into the U.S. at favorable tax rates? Kyle or Brendan, jump ball, whoever wants to take this. Did that happen in any big material way? Or another way to put it is, are a lot of profits still sitting overseas untaxed?
So the part of the reforms to the international system included what they call a deemed repatriation provision. So whether the cash was brought back or not, the federal government deemed that money to be repatriated and taxed at a lower tax rate. This was in exchange for a new system going forward that would tax foreign profits at a low minimum tax rate, and or for any profits taxed above that, they would be excused from tax. Now, I think it's a separate question whether that has any impact on the U.S. economy, but I certainly think that the government collected revenue from that provision.
And now we're sort of digging through the numbers, Brendan, but my understanding in part was, and correct me where I'm wrong, that government revenues, despite the tax cuts, have been, somewhat steady over the past, COVID makes things a little bit weird. But that spending is kind of structurally 3 or 4 points higher than it was pre-pandemic. Do you think that spending is structurally higher because inflation remains in the system and will work its way out? Or is spending structurally higher and will it stay that way?
So I think a key thing is that the projected deficit over the next decade is actually lower than projected pre-COVID, which is really good news when you exclude interest, which is obviously an important part of that, the primary deficit. So that's good news on the deficit front. But what we're talking about right now, we're talking about extending these tax cuts, which are not part of the CBO baseline, and would exacerbate that and would cause debt to, continue to grow, interest rates to rise, and, make, buying a home, investing in a business much less affordable than it is now. So I think that really lays the stakes that we've actually made some good progress on the deficit over the last, few years relative to pre-pandemic projections. Obviously, again, when you exclude interest, but passing these tax cuts without paying for them, just putting them on the credit card would exacerbate the situation.
Well, I think part of the problem is what you said. So it would be one thing if we were arguing about, the size of the deficit and we had no debt. But because the debt is already so high, anything that adds to it feels concerning. So a lot of people who argue that the tax cut plan was are actually more concerned about what it did to the debt pile and how much it boosted us. So here we're starting at 120% of GDP. And you could make a case that the interest payment on that is now the most important factor going forward. So I don't know if we should really be asking about the plans around tax cuts or if we should simply be looking to the Federal Reserve and potential and economic slowdown to lower rates and maybe bail us out of the situation, Brendan.
Look, I think the key thing is that, both candidates actually have proposed pay-fors for extending the tax cuts in some sense. President Biden has proposed, letting them expire for the top 2% of households making over $400,000, and paying for the extension of the tax cuts below that amount. Donald Trump actually does have some pay-fors. He has proposed a 10% tariff on all imports into the United States and a 60% tariff on all imports from China. That is actually a huge revenue raiser. It raises about $3 trillion over 10 years. It helps pay for those tax cuts. But of course, it actually really hurts families. It actually wipes away all the tax cut they would get from extending those tax cuts. It's about a $1,500, $1,700 tax increase for a typical family, which wipes out any tax cut that they would get from extending the Trump tax cuts.